Good afternoon and welcome to episode 67 of Uncommon Sense. Dean Holmes here. Craig Kamanis is in the air. He's only an attendee by name on the front now, so he's unable to attend again today. So he gets a bad rap there, Mitch, for not attending. But I do have Mitch, who was our scheduled guest. So thanks, Mitch, for jumping in today. Mitch, we were just chatting before about your title and what we're going to call you. Besides a good bloke, we will call you Head of Group and Strategy at Coastal Advice Group. So I wanted to talk to you today about all the business owner role of strategy, purchasing businesses, integrating those into existing practices and a few other challenges that we're seeing. But Mitch, over to you. Tell us all the things you do today.
Sure, let's get into it. So I've come from an institutional background. I started as an advisor, have passion for the financial advice industry. I got my start in a small boutique family office on the central coast of New South Wales. And it was just serendipity that got me there, really. I think I have that quintessential path into financial services that you hear really regularly, which is I just fell into it.
Yep.
I was studying engineering. I liked the way that things work. I hated studying engineering, dropped out because I got an opportunity in the financial planning practice because I met the CEO at their Christmas party one year, and he told me that he wanted me to come and work for him. So I was put in a damp, dark room in the back and handed a yellow pages and told that whatever meetings that I booked for the financial planners, they'd take me under their wing and teach me their wares.
Yep.
So I then, rose through the ranks in distribution through life insurance distribution with a number of the major players. The final role that I found myself was head of strategic partnerships and looking after all of the platform and licensee relationships around Australia. So I had I studied post-grad business, had a pretty good business acumen, and that desire to and that understanding or desire to understand how things work, I think translated really well away from engineering, which was a little musty for me, into something a bit more exciting, which is financial planning. I started over in Coastal near on 4 years ago in a general manager role, have grown through that into the COO and was COO for a period up until, due to the growth of the business, it just became untenable due to the size.
Yep.
And the evolution of the org chart for me to continue trying to put all of those pieces together. We needed to build out another layer of management to do that. So my role of head of growth and strategy in Coastal now is to look after the growth and strategy, both current and future, for the financial planning business alongside the CEO, Dan Brown. I look after all of we call it FOCking, finding, originating and converting merger and acquisition deals. So I deal with the vendor engagement, deal structure, contracts, finance, settlement, all of those sorts of things.
Yep.
And then I look after the other peripheral businesses that we have within Coastal Advice, being our accounting and our lending services.
Magic. And can you give us a little bit of an idea about the size of Coastal Advice Group now? What was it when you started? Maybe what was it when Dan was just on his own? Like how big has the growth been?
So in 2016, it was Dan and two other people.
Yep.
We now have 57 onshore staff and 2 offshore teams, one that perform our administrative and operational tasks, another team that geographically separated, specifically for a reason. From a BCP point of view, we decided to have 2 different geographical locations for us for business continuity was sound. So we've got one in Sri Lanka, another in the Philippines. One of them does admin, the other does paraplanning.
Yep, cool.
Both of those, you look at where they are geographically, the hurricanes and typhoons and all of the things that goes on, at least you don't shut down half of the business at any one stage. You got a contingency in place.
Absolutely. And how many people would be across all of those?
There's another 20. So
20.
we're at about 80. We've got a couple of acquisitions that will land in the next 6 weeks that will have us verging on 90 people
Yep.
within the postal advice group, both onshore and offshore.
Excellent. So, and an idea of just that magic number of like revenue per advisor, like where do you think you sit, or number of clients kind of thing? Where do you sort of sit at the moment?
Number of clients I did the other day. So per advisor.
Yeah, I can times it by the 57.
The
Oh
number
no,
of
how many advisors are in the 57?
15 at the moment.
15 advisors. Okay. Yep.
We've got about 1.1 verging on 1.2 bill assets under management at the moment.
Yep.
We've got annual average recurring income of roughly 6,700 for clients that were on client service agreements. Yep. Advisors at the moment are looking after about 120 clients. Our aim was to get them all to 120 clients. We've got sort of a mixed goal there. We've got a certain revenue threshold, so it's client numbers up to a certain amount, and then once you hit a revenue threshold, we start to strategically move them around to allow the advisor to pick their avatar and their premium clients and really give that high quality service to the premium client.
Yep, brilliant.
So they're running that at the moment, but we've got some projects underway at the moment to build some efficiencies into the business, which I hope that none of my guys watch this because they haven't been told yet. But the expectation around client numbers will go up because
I did a podcast with Ensemble just this week with James, and it might be out today or tomorrow. But I was talking about the same about let's find what the true maximum number of clients that a single advisor can look after and solve for everything else, right? So my story was maybe we don't have an advisor shortage. We just have advisor inefficiency, i.e. that advisors are doing something that they shouldn't be doing and they should be doing meetings, because meetings is the only thing typically that someone else can't do.
Seeing clients, giving advice, and collecting revenue are the three things that we want advisors to do. That is it.
Yep.
That is it. And we've built a structure around that to ensure that the team or pod structure that we run, the way that we've built out X-Plan with cases and all of the threads and the workflow that we have, the support teams and the specific roles that they play, and also some of the tech that we're starting to deploy, means that just that sheer opportunity cost of the waste goes away. So they get to spend their time doing what is valuable and what is their highest and best purpose, rather than typing away in front of a computer, nutting out another from scratch file note or whatever it might be.
Absolutely. So let's talk about practice acquisitions or acquisitions in general. So I'll let you talk about maybe a couple of war stories or things that you've done in this regard. But I would love us to talk about the two different types of acquisitions that you might think about that will come across your desk. The buying of a book, traditionally buying of clients, whereby you take the clients and you bring them into your business and they're serviced by the existing advisor, versus what we'll call merging. So bringing in an advisor and a book into the business, maybe as part of a 5-year retirement plan, or maybe the advisor just doesn't want to work anymore. Talk to us about both those opportunities.
Gotcha. So there's probably I'd separate that, and you're correct. There is two real guises. There's a merger and there's an acquisition, but there's actually I'd look at splitting that acquisition into another two subsets. So if you don't mind, I'll talk through all three.
Please.
All three of those. So. The weight of the market at the moment, we're seeing a lot of, which leads to there being those two offerings, being a merger or an acquisition. You're either seeing smart advisors now staring down the barrel of what's happening in the marketplace, their age, living and breathing what they're developing for their clients, which is a succession plan. You know, it's that old adage of the builder's house is never done.
Yep.
Well, the financial planner who's looking after everybody else's succession has maybe not looked in their own backyard. So there's two different types of acquisitions that I'd talk about. One's a plug and play, and the other one we've coined a renovator's delight.
Yep.
The plug and play is where you've got a really solid business that's been run really professionally. There's one or two platforms. You're not running all of these disparate platforms for random reasons. They have their own investment philosophy and are very, very aligned to what they do, why they do it, and what the value to the client is. We have a very specific and aligned investment philosophy. So for somebody to have been operating in that way, it's going to be very easy. They're aligned on pricing and the way that we price, and they're I wouldn't say they're light on resources, but they're efficient with resourcing. So ultimately, they've got high recurring revenue multiples and high recurring revenue, which leads to probably a really good outcome for them and a great result to the bottom line. The renovator's delight, ordinarily you see as a bit of a mess.
Yep.
They're really resource heavy because they're running around in circles, because they have the opposite of what we're talking about there. They've got multiple disparate platforms running, bespoke portfolios for everybody. They're stock picking, their market timing, their pricing's really low for all of the work that they're doing. They're running in a way that is probably separate to the way that we would run the business. Some of the tail end of their business we would see, and having done pricing and all the analytics, we are acutely aware that we would run them, that they would have to run at a loss. It's just something that we're not really willing to do. We've coined the phrase passing the first class champagne back to economy.
Yep.
We do not run a business by passing the first class champagne back to economy. The first class people that pay for first class get first class, and there should be no wastage from that.
I call that my one, just to trade analogies, is I call that the Robin Hood analogy. You're stealing from the rich, i.e. they're paying for your time and you're giving that to your poor. So absolutely, every client should stand on their own 2 feet in terms of the pricing.
Yeah, so we get to that point, and that's where we find ourselves in a. We've got a bit of a project. We've got a bit of cleaning up to do, and we feel in those circumstances we feel like there's a lot of opportunity, but there's also going to be a bit of work, because
it's hard work.
That actually shows a vastly different mindset and business methodology to what we would ultimately be running on our side once they join.
And the other interesting thing, generally speaking, about valuations, which we'll probably get onto, is that there's a misunderstanding, I suppose, that someone that's got this renovator's delight thinks that their business is valued in the same way that a plug and play business might be.
Absolutely not. Absolutely not. The way that we value it is we know incrementally where our sunk cost and our opportunity cost and direct cost is going to lie with all of these businesses. Sunk costs being, data being all over the place, X-Plan not being utilized correctly, everything's on spreadsheets. The integration of that business and the sunk cost of integrating that business is going to be significant to us, and we can't pay for it. It hasn't been a failing on our side. It's a nuance to the structure of their business and the I suppose lack of sophistication in their business that means that what can be a simple transition turns into something that's really glorious.
And so that in that perspective, Mitch, you're saying that you would pay less for it, so you would be asking for a discount because of all the work that you have to do in the first year to get it up to standard.
And that's all baked into our valuation methodology. So clients with higher fees are apportioned a higher multiple.
Yep.
Clients that are within an age range that foreseeably are going to engage for a longer period of time. So you've got like a bit of a bell curve for ages.
Yep.
Your middle ages, your 40s to 55s, you probably get the most because you're looking at where you keep them happy, satisfied, and you show them the value. They're a long-term, high value annuity paying client. And it sort of goes from there. We look as deep as regional versus metropolitan areas, and proportioning a specific multiple to those. To have that deep, it's really interesting in certain circumstances to get to a business and they go, we'd like to entertain, and they don't even have that information available.
Yeah, correct. So you're actually helping them get their business ready for sale almost by you asking great questions in your due diligence.
Yeah. So we've actually had to develop a sale ready checklist. When people come to us, there's Daniel did a blast out to the network about this as well. We just did the work up front and put together a sale ready checklist.
Yep.
I don't mind paying good money for a business that's easy to onboard and that's going to be resonant with the way that we're doing it. So here's a sale ready checklist. Go and fix all of those things up. Make sure that they're ready to go. Then come back and we'll
Yep.
conversation's going to be a lot more positive.
A lot easier. So now let's talk a little bit about this the merger versus buying the book. Like what are you looking for either way, and how do you decide, or how does the vendor decide which path they want?
A lot of that comes down to values alignment, because if you're going to have with a merger, you're going to have people sitting around the table. In an acquisition, our MO for all of these, and our wholehearted belief is that you're not just buying revenue, you're buying goodwill, you're buying relationships. So our desire would be that in every transaction, the vendor and their staff are looked after, right?
Yep.
We want there's 4 levels of value the way that we see it in doing an acquisition. There has to be value for the clients at the forefront, otherwise there is no business.
Yep.
There has to be value for the staff because they are where a lot of that goodwill lies. A lot of vendors think that it lies with them, but in a lot of circumstances it's not. It's the staff around them that make it look good. The vendor, and then there's us. All 4 of those parties need to get value or it just doesn't work. So our desire in all of these is to bring the vendor along for the ride where they want to.
Yep.
So for an acquisition where they want all of it off the table and they're happy to stay around as an employee, that's cool, and we love that, and we've done that really, really successfully.
And you'll find that you then one of the things that I think about that, Mitch, is that then are we performance managing someone that's never been performance managed? Like, are we like they turn into an employee? Isn't this like getting a wild horse and bringing it into line?
Oh, there's probably other descriptions that I could use, but that's probably the most PC way to put it.
Yep.
It's also really positive though, right? So yes, there is always struggles. And what we have found is that being upfront in our negotiations and our initial engagement with these guys is so critical to spell out exactly what it's going to look and feel like. They need to understand we've got a business. They've got they may have a very successful business that they've been running for 20 years, and there's going to be some baked in principles and things that they like to do. Our MO is that we love to run best practice. So we're never just going to say it's our way or the highway. There's certain situations where that's the case. And that is, we are now I suppose in our marketplace, we're a large business. We've had to corporatize. We need consistency and structure and a certain level of oversight and those sorts of things that mean that we have really defined systems, processes, investments, products, platforms that we use because we have chosen them, vetted them, and have a relationship, a commercial relationship with them, not a financial commercial relationship, but a commercial relationship with them that gives us the the confidence that as a solution for such a large number of clients, they're fit for purpose and that they're going to gel well with the way that we run the business.
Yep. Understood.
That is going to differ significantly every single person that you speak to. So the tough part is that initial engagement, letting them know that on one side, they're going to be able to let go. They're going to be liberated from HR, financials, running the business, leave, resourcing, all of the things that they used to have to deal with, being butcher, baker, and candlestick maker. We have departments that do, or specialized individuals within the business that are going to perform that for them. So whilst there's real positives on the other side, they have to be prepared, noting that they will be an employee. They have to be prepared to come along for the journey.
Yep.
And we're not telling you that what you've done previously is wrong. We're just asking you to come along for the journey and look into what we believe is a different, won't say better, but a different, easier, more efficient way to achieve exactly the same thing, to allow you to spend more time doing what you do best, which is seeing clients and adding value.
Yeah, and it doesn't, whether the vendor sells out completely or and becomes an employee, or there must be this interim step where they own some equity in the group, call it the merger. They still have to comply with the employee as well. They have to still perform in that role.
That's me.
That's
me too. I'm just a shareholder. You know,
Yeah.
in that respect, I'm just a shareholder. I'm lucky that I'm in the leadership team and management team, and I get to have, you know, a seat at the table. And I'd like to think that most of our shareholders and seniors believe that they've got a seat at the table because we operate really collaboratively.
Yep.
All of the business plans and things are put in front of our shareholders on a yearly basis after we've done our forward-looking strategy for them to critique. You know, tell us where we're wrong.
Yep.
There's smart people in the room. Tell us where we're wrong. Tell us what you'd like to be done differently. But they do need to come along for the ride on certain things, and we do get if that there can be a bit of friction there. It becomes a bit abrasive sometimes because that. And I understand that from the advisor's point of view. They've been doing the same thing for 20 years. They believe that it works. We don't necessarily believe that it works. And it's a hard conversation to go back. We're asking them to try something different. They've got to go back and ask their clients to try something different. And I suppose it's that really interesting juxtaposition that they find themselves in a position where they need to sit in front of a client and say, look, I've been doing something for 20 years. And I'm not saying it's wrong, but we're just going to try something different. So I do understand the emotion that goes into it, but they have to be prepared to do that. Otherwise, it's just not going to work.
Yeah, absolutely. So that was one of my next questions for you, is like the challenges with the integration. And so obviously there's a human challenge there, Mitch, in terms of getting the advisor to be willing and open to change, and then actually helping to execute the change that they've agreed to.
Yeah.
What's some other challenges that come up in terms of these businesses you're looking to, you know, buy or merge with?
I'd say cultural alignment.
Yep.
So when you run as fast as we do, there's a real focus on cultural alignment. All of the data and learning that we have done would point to the fact that if you get culture right, you don't need to worry about anything else. It will just follow.
Yep.
We have now just ventured so we've got offices all up and down the eastern seaboard of New South Wales. We've got practices in Adelaide, and we've got others in another couple of states that we will settle over the next short while. Due to the size and scale of the business, that desire to have a culture fit becomes harder and harder. So we've gotten to a point now where we've just hired a specialist role within the business, and I suppose this is where scale brings opportunity.
Yep.
We've just hired a role in the business, a lovely gentleman by the name of Ben. Ben is the perfect person for this role. One of the most vivacious guys that I've ever met, but he leads our wellness and culture. So he's our wellness and culture coordinator. So a specialized role in our business. where we can now, after post acquisition, we can deploy a specialized resource in to try to fold them into what we are doing. Have an individual in their office that sets up and stands up the culture club and coordinates all of the events and things that we roll out throughout the business, embeds the employee value proposition across the business and make sure that everybody gets all of the full value from that. So culture is probably the leader. And one of the hardest things, I think any business owner can attest to the fact that even if you're on the ground, culture can be one of the hardest things, but running it through geographically distributed businesses becomes even more of a challenge.
Yeah, correct. And we're finding that the remote businesses are working from home and actually also translating the culture from Australia to the Philippines to Sri Lanka is also the multiplying challenge as you do that as well.
Yeah, agree. Wholeheartedly agree. The other one would just be the challenge. So getting away from the people, I've probably spoken enough about the people, and there is challenges with people, but they are certainly not insurmountable. It's just my viewpoint on that is, and one of our values in Coastal Advice is 100% of the truth, 100% of the time.
Yep.
We have to lead with the truth. But we also need to listen to what. Listening is so powerful. Everybody says it. You've heard it 1,000 times at PD days. But listening to the vendor and what they're saying and where what they're saying is coming from and getting a real understanding of their motivations, I think that really sets you up for success because you'll understand whether you're going to get alignment or not.
Yep.
On a business front, practice readiness, we touched on before, but some of the challenges that we've got is the assumption by some of these businesses that their data is tidy and that they're ready to go and that their business is sale ready, and some of them are just in an absolute shambles.
Yep.
And we very smartly attribute some cost to the acquisitions. We know that there is going to be direct costs for embedding these new businesses, but some of those where you do your darndest to get all of the information out of them, do all of the due diligence and checking, you just get sideswiped by things. That's data, that's clients, that's where they're up to with their reviews, that's the advice that's been provided previously. You can't go through all files when you do.
Yeah, we were chatting. I think we said that there was potentially a lot of unmet advice opportunities in these acquisitions, and it's testament to sometimes the advisor in a one person practice or a smaller practice hasn't got around to doing all of the potential advice opportunities. And so obviously that's a good thing for the future business, but it's also hard with that integration of you can't find that out until really you get into the detail.
That's exactly right. And I think you just have to be ready for it. And we've learnt from the school of hard knocks and we're now ready for it. So that's one of those readiness things that I would say.
Yep.
Practice readiness. So readiness around data, the transition of data, the cleanliness of data, the clients and where they're up to, their sentiment and the prior advice and the advice opportunities that you alluded to. And then the individual culture within that business. Now, the reason that I say that is culture's not hard. It's just a process like anything else. And coming into a corporatized business like ours, culture looks completely different. It might not just be, a bit of banter in the office and being able to do this and do that and get away with what you can in a smaller office. And culture for us and the transition of culture from a small business to the big business is probably one of the challenges because they come from a position where they can message their boss and go, I'm not feeling well today, I'm going to work from home, or my kids are on holidays, I'm going to work from home, I'm going to do this. And that's not to say that we don't have a level of workplace flexibility, but there's we've got a process for it. You got to fill out a form. You got to take photos of your ergonomic desk setup. It's just
things we need to do now. Absolutely.
Yeah, it's just a shift away from the simplicity of what it used to be to doing it correctly. All the same things are available, but we're the size of us now. We got to stay out of the spotlight. So
Yep.
we got to do things really, really right.
Yeah, absolutely. And so anything else with the integration, or should we jump down the list?
Volumes.
Tell me about that.
Volumes. So staging. Everybody wants to run an efficient business. We want to run an efficient business. We don't want to hire people for the sake of hiring people. Don't really want to use consultants as much as we possibly can. In my role, I truly believe that we can use incumbent employees correctly if we stage it right. We run our business highly by data, so we need to be acutely aware of our resourcing, the capacity, all of those sorts of things. Both from an advice point of view and an operational point of view is really important. And we need to be acutely aware of our staging, because Dan and I could just run out and, we got a pipeline, an acquisition pipeline at the moment with 16 open conversations. We'd very easily go out and throw money around and land half of those tomorrow.
But you can't integrate them.
But the machine would fail.
Yep.
So for us, I wouldn't say it's a challenge, but it's certainly a focus. And the challenging part is getting all of the right data and challenging yourself and your business to really understand how your business is operating first before you go throwing more stuff at it, because then you end up just throwing the proverbial at the wall and seeing if it will stick. And that is not the sign of a successful transaction. You want all of it to stick.
You definitely want to be acquisition ready before you jump in and do that acquisition.
Right. So we need to redo that every time, right? So we've done 5 this year. We've got another 2 that will land in the next 4 to 6 weeks. Every time we need to go back to the drawing board and go and look at resourcing and go, can we fathom this right now? Or are we going to break the machine? Are we going to lose people? Are we going to burn them out? Are we going to have huge rounds of sick leave? Do we need more people? Do we need to restructure people? Where's the focus? So it's a business readiness on our side too that's really, really important.
Yep. Absolutely. And so changing track a little bit in terms of your desire to add additional services as you grow, how are you thinking about that in terms of offering that as an option for when you're bringing practices in? What are you involved in besides financial planning now?
So this has always been a goal of mine. I had to prove it to the CEO. He believed that it was a little bit fraught. I've had in my role coming up through distribution and having seen some really successful practices. I'd seen the benefit of aggregated services with things like lending and accounting.
Yep.
I feel like debt is the cornerstone of financial debt, and cash flow are the cornerstone of financial planning. It dictates a lot of what you can and can't do, and a lot of your cash flow and outgoings. So if you can add a little bit more cash to your bucket strategy, or add a little bit more cash to something other than paying it to the bank, happy days. It's also an enabler for things like gearing and investment and that sort of stuff. So I think that there's a real congruence.
Yep, absolutely.
Accounting, we also added. Again, I had to prove test case. But we've acquired now both a lending and accounting business. The accounting business is a bit of a different offering to what you would tend to see, and I did this for a couple of reasons. We've got a couple of really sophisticated professional accounting referral relationships that I didn't want to disengage.
Yep, absolutely.
They also didn't want to do our individual tax returns.
Yeah, okay. So this H&R Block maybe is not the right example, but it's that core that needs a quick, efficient tax return. And given you've got all the data or most of the data, you can turn this around relatively quickly for a client.
Correct. But I can't collaborate with H&R Block. I can't get assistance from H&R Block. They don't get the same touch and feel, all of that sort of stuff.
Yep.
So now I've got a really quick, efficient, collaborative, connected solution to send our clients off to get simple ITRs done, to get their franking credits sorted out, whatever it might be,
Yep.
whilst also not annoying our referral partners.
And did you talk to your referral partners before as you were making this decision?
Yes,
Yeah.
yeah, had to.
Yeah, absolutely.
They're too beneficial, and we still any of the sophisticated SME financial work that people want done, we won't touch. Our accountant doesn't want it. So we literally will just do self-managed super fund setups, company setups, won't do the financials for them. We will just do their returns. That's it.
Yep.
And ultimately, a lot of the guys that we were using do not want to do that. They want to do your sophisticated accounting work.
Absolutely. That's where the value is. Like if we think of advisors moving up the value chain, you want your best accountants moving up that chain as well. But there's some jobs that still need to get done as well.
So there's not a so on that side, there's the service delivery to clients, which I think, which is always at the forefront. Another value of ours is client first. I did that to ensure that the business could take control of the service offering, the touch and feel, the premium branding, and the delivery of those services under one roof.
Yep.
The side benefit of that, and we all know it because it's been spoken about ad nauseum as well, is putting a picket fence around the clients. If they get everything under one roof, it's harder for them to unpick the relationship, right? There's benefit that you're providing when they just drop in and they get everything done. It allows us to collaborate on all of those things, information share across all of those things to simplify getting the outcome for them. So there's a secondary benefit for us as well.
Absolutely, very good. So it's a key part of the business growth, and that share of wallet or getting the services. I know the Commonwealth Bank knew that if they had the right number of products, that you would never leave the Commonwealth Bank, and so there's plenty of people listening that still have their Dolomites account. They started at that point, and they've still got you now as a result.
I do.
There you go. Yeah,
I'm
in the same category. So they either brainwashed us Mitch back then or something else, but that's okay. The last thing that I wanted to pick a brain on in terms of this is just we had a bit of a chat around licensing. And there's a trend, I think, to people going self-licensed to do it themselves, to have this flexibility. What's your views currently as you are licensed in and around this?
The licensee space, I won't say it's in a bit of turmoil at the moment, but there's a lot of institutional change going on the licensee space. The whole world for licensees has changed over the last little while, and I think they're all vying for their place. There's a few that are doing it really, really well. So we're with one of the larger licensees. They do a fantastic job. They really, really do. And for us, we at our size, we get asked really, really regularly, like, when are you guys just going to go self-licensed? Doesn't make sense for you to be there anymore. I'd actually argue that it does. We've got a big partner, a sophisticated partner that it's in a position to continue to help us on a number of fronts. Ready-made compliance, the back office that they've got, the assistance that they've got in some certain realms, having somebody that's in touch with government, in touch with legislation and rolling out standards that are applicable to that without us having to really follow them. You've got your aggregated buying power and all of that sort of stuff. There's a lot in it.
Yep.
But I also find that with the change that they're going through at the moment, there's also a lot of opportunity within larger licensees. Their mandate in a lot of circumstances at the moment is to, I won't say off-board smaller practices, but there's a minimum viable practice really, just like for a licensee, just like there's a minimum viable practice for an advice business. And I think there's value for, given your audience and the understanding that I have of your audience. Anybody that's in a larger licensee, I would suggest that the benefit is that you can engage your RBM and make sure that they really understand what your ideal client is, what your ideal merger or acquisition looks like, and they should come to the game and help you. You can literally solve a problem for them whilst getting a gain for yourself. And the simplicity of transferring a business and integrating a business inside a licensee cannot be, it cannot be understated. The
So
simplicity.
that's it. Yeah. So that it would be a public fact, but you've bought businesses that are inside your AFSL,
Yeah.
inside Rhombus. Yep. And compliance and legal wise, it's a quicker transaction than bringing clients across from another AFSL.
Absolutely, they literally flick a switch on Xplan, and the revenue starts coming to us. They've already got all of their ARs set up. They just come to work the next day, and there's a new sign on the door, and they've got some new processes to run.
Yep. Yep.
It's really really cool, and because the existing license was the previous advice delivering entity and all of those sorts of things. There's heaps of simplicity that comes with doing internal transactions like that. So yeah, look. There will be a point where, from a return on investment point of view and an OPEX point of view, there'll be a point where you weigh it up, or any of your listeners may weigh it up and go, if I'm paying $300,000 in licensee fees, could I not run my own license with one of these sort of aggregated offerings and get all of the same things and save some money and have a bit more freedom? Well, probably. But also don't look a gift horse in the mouth. The support that we get out of a larger institutional licensee has been phenomenal, and it's always my role and Daniel's role as CEO is to act in the best interest of the business, and they're ultimately the decisions that you have to make once you become a shareholder-owned business. And for the time being, our opinion is that it's the right.
Works. Yeah. I've got my running example at the moment is there's a guy called Josh in Count, and he 100% of his effort is dedicated to Copilot and working out AI in financial services. And so if you're in a small licensee, there's no resource like that that's trying to solve that problem for you. And so I always contrast is, yes, you get a lot of flexibility, but the things that you give up, I don't think you know until you've left. And so I'm trying to bring awareness to the story that actually there's a lot of things in the licensee world that are really positive in these large AFSLs. And you might have to tick 2 extra boxes. But if then you're gifted with an acquisition, Mitch, because you're in the same licensee and you can do it, that's going to make you many hundreds of thousands of dollars in the future.
And a lot of it's just rubbing shoulders. It's just the events that are available to you. It's the channels and forums that are available to you. And in a lot of circumstances, when you're a standout practice for them, they want to put you up on a pedestal too, to talk, to do the same types of talks that we're doing now. And people start to hear our story and what we're doing, and they'll just flock to us. That was one of the other things that you wanted to talk about, was the future of M&A and what that looks like for us. I don't know. Do we still have time? Or we still?
You got like 2 minutes. You can have the final word of that.
The future of M&A for us, I suppose, looks like exactly that. Using the platforms that we've got, we're at a scale now and a corporatized model that creates opportunity. We're sort of in a position where success with our process has created a bit of momentum and relationships out there, where we've now got brokers that want to work directly with us because they know that we've got the financial runway, the business acumen, and the testaments from previous vendors that we've worked with to say these guys can just do it. With one of them, we did a deal in 7 weeks, from negotiation of heads of agreement to settlement in 7 weeks. And it's been one of the most successful transactions that we've done. To the extent that we even received an email from the vendor to say, this has been the best thing that I've ever done. Thank you guys so much for the way that it's gone. So we're using, they're coming to us because we're getting a bit of rate of momentum, and we're making sure that we're doing PR whenever we do this stuff.
Yep.
I think PR is really important for any of the listeners out there that are doing this well. Don't be the best kept secret. That's not what you're doing it for. If you're doing good stuff, make sure that the market knows you're doing good stuff. Build relationships with brokers and make sure that you don't stuff them around. There's nothing more that both vendors and brokers hate than being, for want of a better term, dicked around. Or not in a position to acquire. If you don't have the runway, don't play.
Don't put your hand in the ring.
Don't put your hand in the ring. Don't play with them, or you're never going to get an opportunity again because they'll deem you a tire kicker.
Yep.
If you're not a tire kicker, they'll come back to you, to the extent now that we've got brokers that are just handing us deals saying, I know that you can get this done. It's going to be hard for other people to do it because of their size and, the size of them and the way that the banks will lend. And I think the other opportunity would be, we've got really specific roles now where Daniel and I focus on the merger and acquisition. So we get to put we work really, really hard on it, our branding, our exposure, our roles to go out and find, originate and convert these deals. So we're out there networking, we're doing our own branding, we're doing our own campaign work and all of those sorts of things, building out the readiness.
Spectacular. Absolutely. So that's the end of there, Mitch. But there's obviously many more podcasts that we can do. So we'll take our list. We'll take our questions and comments, and we'll probably turn it into another version. But thanks so much for your time and sharing your thoughts with us today. It's obviously on LinkedIn to anyone for watching live. Otherwise, it's on the podcast as well. So if you're walking the dog, enjoy the rest of your walk. And thanks very much, Mitch. See you next time.
No worries. If there is any questions or we didn't get to it, shoot them to Dean and I'm happy to